Oil. You've heard everyone talking about it, investing in it, predicting that the price will skyrocket or claiming it will plummet. If you want to trade oil, please watch this video and I will teach you how to simply analyze the market yourself and what to look out for so you're not just blindly trusting the hype. Number 1, geopolitical tensions. And this is relevant especially in today's market when we get any wars between countries. That has a massive impact on oil prices. Let me explain what I mean. Let's take the two biggest examples that we've had over recent years. Obviously the Russia and Ukraine war, and more recently the Israel and Iran war. What tends to happen is these are typically oil-rich exporting companies. I believe that Iran exports around 1.3 million barrels of oil per day. What happens when you get geopolitical tension between these two big economies is they tend to attack these oil facilities. Now, in theory, when you attack an oil facility, you're essentially destroying that oil facility, of course, and you're reducing the supply of oil into the market. When you reduce the supply of oil into the market, that increases the price. So what you need to understand is that when we have periods of heightened geopolitical tensions, wars between countries, especially oil-rich countries, that means we're going to get higher oil prices. And I can show you an example on the chart. Literally most recently, we saw the Iran and Israel war really starting to kick off, and we saw Israel and Iran actually starting to target these particular facilities. Israel attacked Iran's Karg oil terminal over the last few weeks, and look what happened to oil prices as a result of that. So oil prices were actually trading in a downtrend, and it was at this point that we got the news overnight that we saw Israel start to attack Iran's oil facilities. As I said, that strips away the supply of oil for Iran and therefore increases the price globally. So we saw an increase there of nearly 6% in oil just overnight from that news. This happens across the board, so it's always important to stay up to date with what's going on in the world when it comes to warfare. Number 2, OPEC. Now, OPEC was formed in 1960, and its 13 current member states hold more than 80% of the world's proven oil reserves. And what this group aims to do is basically regulate global oil prices by coordinating on reductions or increases in production. Now, as traders, we get access to that information. A lot of people don't really tend to check it. And if you're looking to trade oil, I would highly recommend that you check the crude oil inventories report. You'll be able to see it on any economic calendar that you've got, and it's normally a weekly report that we get, and it's OPEC's decision on whether they're increasing or decreasing the supply of oil. So let's look at the last few recent examples. As you can see, OPEC have decided, in the times where we had economic warfare, you can see that they've decided to actually reduce the production of oil inventories by minus 11.5 million. You can compare that to the forecast and what happened previously, and you can use that to determine whether you're bullish or bearish on oil for that day. So on June the 18th, for example, OPEC decided minus 11.5 million barrels in oil production. The forecast was for minus 2.3 million. They've actually taken even more inventories out of the market than what was expected. That's bullish for the price. So here on June the 18th, OPEC decided minus 11.5 million barrels of oil as their production. Minus 2.3 million was the forecast. That was bullish for oil prices. And if I go to June the 18th, and you can see what happened on the days leading up to that and what happened as a result of what OPEC decided to do. So although it's typically seen as like a light impact news, it's not as impactful as like a war scenario. But generally, you can see the direction of oil prices after they released the report traded higher. In fact, in the 24 hours after the report was released, oil prices gained 4.8%. So you can look to benefit from that. Watch out for those weekly crude oil inventory reports. If they decide to flood more supply into the market, that's bearish oil. If they're taking more supply out, that's bullish oil. Number 3, economic cycles. The way the economy is performing has a real impact on oil prices. And I'm talking this time from a demand point of view. So with anything in the world, you've got supply and you've got demand. And in the previous 2 points, we spoke about supply. The economic cycles are really all about demand. So if economies are booming and they're in a period where lots of things are being produced, everyone's got a bit of money, they're going to be consuming oil products like petrol, etc. much more frequently. They're going to be flying a lot more on their holidays. Therefore, the aircrafts are going to be using a lot more oil for their petrol. So typically in a time of economic upturn, we can expect oil prices to be higher. And there's a correlation there with GDP and oil. In times of economic downturn, that's when we can see really sharp decreases in oil prices. The easiest example to look for, go back to 2020 during COVID, where the world shut down. No one was flying, no one was driving, no one was leaving their house really. Companies weren't producing goods or services at the same rate as they were before. Oil prices turned negative for the first time ever. In fact, the price of a barrel of West Texas Intermediate oil, WTI, the benchmark for US oil, fell as low as minus $37.63 a barrel. Essentially, you had to be paid to take oil off. It was crazy. But it's an example of what can happen during times of economic downturn because it reduces the demand prospects. So you can see that the price of oil in the lead up, this is from 2000 all the way up to 2020. 2008 global financial crisis, look at the price of oil, massive spike lower. Again, during COVID, massive spike lower. Again, this does open up opportunities, a bit like on the stock market, to actually buy up oil because these economic downturns don't last forever. So let's just go to the spot price on my trading view chart on crude oil here, and you can see prices fell to zero on the spot price. So the futures prices went negative, spot price, that went to zero. Hindsight, of course, but probably the opportunity of a lifetime to buy. And I bet you there's traders out there, clued up traders, probably institutional traders that saw this as an opportunity whilst everyone else was panicking, and they bought oil. And the result was from April 2020 when it was at zero all the way up to February of 2022, prices went from zero to $130 a barrel. If you had that trade on, you wouldn't ever need to trade again. That's why it's very important to keep an eye on economic cycles when it comes to trading oil prices. Economy is booming, oil prices higher. Okay, so to summarize, my three main areas to look out for when you're trading oil prices, you don't even really need technical analysis. OPEC and crude oil inventories, very important. Economic cycles and also geopolitical tensions. They're the three main things that you should be looking out for. If you can keep on top of those three things, then you have a really good chance of becoming a good oil trader. If you did enjoy this video, please feel free to give it a like and also drop a comment in the comment section, and I'll be more than happy to answer those questions for you. I analyze oil every single day as well in the Discord channel. It's one of the markets I like to trade. You can check the link in the description and join our free Discord channel today. Also, you can trade crude oil with Atmos. Just go on atmosfunded.com or check the link in the description. You can get started with a 100k funded challenge for the lowest price in the industry. So until next time, trade well, trade safe, and I'll see you for the next video.